Have a good stream, Dylan.
Good check.
And ladies and gentlemen, we are live at 7 p.m. Pacific Standard Time on the West Coast, 10 p.m. Eastern Standard Time on the East Coast, New York, Tri-State area. Shouting out, Blythra is in the chat. Thank you for the yo. Badwolf 007. Shout out to my friend Eric, also in the chat right now. We always appreciate the love on the Dylan Hawley experience. It's been a pretty interesting week on the markets thus far. But before we go any further, I do want to bring something to our attention. Today is December 7th, also known as Pearl Harbor Day. It's been 81 years since the attack on Pearl Harbor. Of course, this is from an American's perspective, but, one of probably the darkest days in our history. There were, we can even just take a look here. 1,143 wounded and 2,335 men and women who ended up dying because of that event. So they are in our hearts always. They will be in our hearts tonight, of course. But we have some news to look at. Stock futures are little changed as investors assess the risk of an economic downturn. U.S. stock futures were little changed on Wednesday night following a fifth straight day of losses for the S&P 500 as Wall Street weighed the likelihood of a recession. Dow Jones Industrial Average futures gained 15 points or 0.04%. S&P 500 futures added 0.02%, while NASDAQ 100 futures was up 0.004%. So stuff has been pretty unchanged in the actual futures trading. And to be frank, it was a pretty uneventful actual trading session as well. We can take a look further here. During the regular session Wednesday, the S&P 500 declined 0.19% in its fifth straight losing session. The Dow Jones was virtually flat, adding just $1.58 worth of points. So it was 0%. Like the actual movement was 0%. Dow went sideways. Meanwhile, the NASDAQ composite slipped 0.51%, 0.5%. The Federal Reserve is expected to issue a 50 basis point interest rate hike next week. It's smaller increase than the previous and prior 4 rate hikes. So again, the Fed came out last week and they were saying that stuff's starting to catch up. So now they're possibly looking at slowing down the velocity at which they were tightening the markets using interest rates and rate increases. And I think what they're trying to gain here and what their actual goal is, I think having a 50 basis point hike in this next meeting will probably do the job just fine. I've always been one to do 75 basis points to close out this final meeting of the year and then start to taper after that. But you know what? They're going to probably go 50. At least that's what the market is pricing in. So it's going to be anywhere between 50 to 75 basis points. If we do see a 75 basis point hike, then I think that'll probably be the final basis point hike for or 75 basis point hike for probably the very near future and probably further on. Quote, we've been waiting for earnings, or excuse me, still the investors are increasingly concerned about whether the central bank can avoid a recession next year in its attempt to squash inflation. Quote, we've been waiting for earnings to come down. We've been waiting for CEOs to acknowledge the fact that a recession is more likely than not. And here we are. And again, I think like humans are a lagging indicator. Like when the Dow Jones and the S&P 500 are down 20% this year from their all-time high. And only until recently, all of the CEOs and analysts and hedge fund professionals and stuff like that, after a 20% move down, then they're all like, oh yeah, we're in a recession now. Oh yeah, stuff's going to continue to get worse. So again, humans are a lagging indicator. I definitely think that the bottom is not in, or this idea of a bottom. Again, I'm not here to tell you when we're actually going to bottom, but I definitely don't think that we are out of this neck of the woods yet in terms of a recession. We can actually just pull up TradingView right now. Let's take a look at the Dow Jones, S&P 500. Of course, I think we're going to end up pulling up Bitcoin first because that's my default asset that I typically look at, and we can even do some quick Bitcoin analyzation as well. Again, none of this is financial advice. It's just me spewing stuff on the internet. Just spewing stuff on the internet for entertainment purposes only. Only entertainment purposes. So it's Bitcoin's been going sideways. There's really nothing super crazy about it. At least from like a macro standpoint, it's still down, 70%, almost 80% from its all-time high. Again, I'm dollar cost averaging in. Like regardless of what happens in the markets, like I've had viewers watching when the markets were at all-time highs, when stuff, it was just green day after green day. I was dollar cost averaging then. Now it's red day after red day. I'm dollar cost averaging now. I'm just buying wonderful assets at fair prices. That's all I'm doing. Dow Jones and the S&P 500, for that matter, there definitely seems to be a clear rejection of buying support. And I think just from a chart standpoint, I would not be surprised if we go down from here. And then, of course, taking in macro sentiment and macro analysis as well. It's not looking fantastic, but the flipped, glass half full version of that is you are going to be able to purchase things that you would otherwise be purchasing at discounted prices. So S&P 500 and Dow Jones at a 20% discount. Yeah, I'll buy right here. And then if it goes down to 50%, I'll buy right there. No, Dylan, why do you say the 50% number? Because 53% was the price action that happened in 2008. So, or actually it's 58.19% down, a negative 58% move from the top of the market in about 2007 down to the bottom in January. Or actually, is that March? Okay, so like early March, late February of 2009, bottom for the S&P 500, a 58% correction. So it's not out of the norm to see massive, massive downward moves for the Dow Jones and the S&P 500 for that matter. And I don't know if we're out of it yet. If we were to do another 50% downward move from an all-time high, we would have gone from 48 down to like 24. It would be like right here. And why could that not happen? If stuff keeps getting worse, if credit markets continue to get tighter and tighter and tighter with the quantitative tightening and the interest rate increases, obviously those are slowing down. But again, these things take a few months, if not into a year, for like the actual physics to catch up on these interest rate increases. So I think that we're just starting to feel the effects, and I think that it's going to have a cascading move through probably 2023. That's really when stuff's going to start to realize. I mean, like the prices are still somewhat out of whack, especially in the real estate market right now. If you look at historical interest rates, and we can actually take a look here, historic 30-year fixed or 30-year mortgage versus home prices. We can actually take a look here. Are they going to give us a little chart? Yeah. So basically looking here. Okay. Yeah. So typically speaking, when there is a mortgage rate decrease, so when the percentage rate of a mortgage goes down, the price of a home goes up. That's this pattern right here. Now, what's quite odd, and this makes sense. So when the mortgage rate goes down, the amount of interest that you have to pay goes down. Typically, the price of a home goes up because it's a hotter market. That's kind of just basic supply and demand and basic economics there. As it's easier to get things and there's a scarce amount of things, people are willing to pay more for those things. Now, when it's thrown out of whack, let's say they flip it. So they bump interest rates and then they make it harder for people to get homes. Well, then the price of a home goes down because it's harder for someone to get an asset, and then it actually flips onto its head where it's then difficult for someone trying to sell it because people are just trying to underbid them. What's going on right now is totally out of whack for basically like the common sense understanding of mortgages and financing homes. What's going on right now is interest rates are going through the roof. Albeit they have come down from the October late or early November high. So we can actually take a look here at the 30-year fixed. I just go off of Google for this. I don't know where they actually get the number, but this is typically the one that I use. So we can do can we just get a Google? Where is this 30 mortgage rates? I think I just have to type in mortgage rates. I think I'm overcomplicating it. I am. Look at that. Lo and behold. Anyway, if you take and this is just like an average California, 20% down, I guess for 300,000. Average credit score 700 to 719. In late October, early November, they actually spiked to 8%. The 30-year fixed it, which is unprecedented. Now it has come back down to 7%. But what's going on with the price of the homes is they have still remained relatively the same, if not still increased. So if you look at, shout out to Fred, which is it's basically just like an economic database from the government. So, take it with a grain of salt, of course. But at least for my research and my understanding of this stuff, I think it's just a good benchmark to look at. So price of a home in Q3 of 2022 is still $454,900. So the price of a home is still increasing as interest rates are decreasing. And this is what's going on right here is basically that complete out of whack, out of correlation. This is an event that normally doesn't happen, and from a physics standpoint and a historical data standpoint should not be happening. So I think that with the real estate market and the home market, I think that 2023 into 2024 is when we're really going to start to see the physics catch up to it, and I think we're actually going to start to see the prices of homes start to go back down and have a correction down, which again is a neutral event. It's a neutral event. Seeing home corrections and seeing assets correct back down to a median or average price for where it should be. And people are gonna take a look at that info and see the unequivocal data and seeing like, okay, well, the entire market's down. This is horrible. This is bad for us. This is bad for us. And I think that type of psychology is only going to exacerbate the recession fears. But there's also some very valid arguments that people are making for being in a recession, and we definitely are in one. I'm not arguing the fact that we're not in a recession. We are 100% in a recession, and I think we're going to continue to be in one through 2023 and 2024. Again, not a bad thing. It's just a correction. Now, one of the biggest signs of a start of a recession and continuing through is job layoffs. And there was a plethora of them this week from Monday through Wednesday. There was a decent amount of job layoffs that were reported. So these are the ones that we're going to be covering, reported job layoffs. Morgan Stanley has allegedly cut 2% of its global workforce. These are coming from internal rumors, so take it with a grain of salt. But analysts are saying, and insiders that are close to the Morgan Stanley employment teams, have cut 2% of their global workforce. And then this is when the ball starts rolling and snowballing, and this is the best high or least amount of people laid off. Obviously, to the 2% of people at Morgan Stanley who were laid off, best of luck to you in your future endeavors. Hopefully you find work soon, and hopefully they gave you some of that severance paper. Hopefully you got a good old severance package. Best of luck to you always. Continuing on, BuzzFeed has laid off 12% of its employees. Digital media company is letting go of about 80 of 180 staffers amid, quote, challenging macroeconomic conditions. BuzzFeed is axing 12% of its workforce, or around 180 staffers, in a bid to cut costs as the digital media company faces headwinds, including an ad spending pullback and the completion of its integration with Complex Media. The company informed affected employees via email Tuesday that they were being terminated. Quote, in order for BuzzFeed to weather an economic downturn that I believe will extend well into 2023, we must adapt, invest in our strategy to serve our audience best, and readjust our cost structure, unquote. This was said by CEO Jonah Peretti, and he wrote that in a memo to his employees about the job cuts. BuzzFeed disclosed the layoffs in an SEC filing Tuesday. The company said the layoffs are intended to reduce the company's costs in response to factors including challenging macroeconomic conditions, completing the integration of Complex Media, and reducing and eliminating redundancies where they exist, and the ongoing audience shift to short-form vertical video, which BuzzFeed is, quote, still developing from a monetization standpoint. So their entire business model was articles and lists and then making YouTube videos. And I still think there's always going to be a market for YouTube videos. You know, there's like longer form videos and stuff like that, but short form is definitely where all the eyeballs are turning to. And I think YouTube's short form platform, they have a much better monetization model than TikTok's right now. But it's like, there are certain dinosaurs that basically hinged their entire business model on like a previous bedrock of how people consumed media, and now there's a new bedrock that more people are using. And I hope that BuzzFeed can do their short form video side of their company, and it does run profitably. I definitely think, like, of all of the digital media companies, I think BuzzFeed has the brand equity to be able to do it. I know from like a news standpoint, they tried to run BuzzFeed News, and it was just a shit fire. There's no other way to put it. It was just a shit fire. It was just like, and this is like, and take it at what you will. I guess I probably have more of a bias towards, like, I don't know, not to say that I'm a classical liberal or anything, but I just believe that the government shouldn't be fucking with people unless they're starving and they should be giving them food. Like, I'm against government handouts, but I also definitely understand this idea of like needing a certain degree of welfare. Anyway, BuzzFeed News was a just complete liberal shithole. Like, and trust me, I'm not defending Newsmax or anything. There are a lot of conservative shitholes too. Let's be very, very clear. But BuzzFeed News was just like a liberal, like, cesspool of just like op-ed pieces, and it was rough. So they couldn't break into the high class journalism market. But I definitely think BuzzFeed's culture and the cultivation of like that casual type of news consumption, I definitely think it could benefit them in the short form video, the vertical video, like that's seen on YouTube Shorts and TikTok. But I don't know. They are also a dinosaur brand. So, oh, and also, dude, have you seen their stock price? BuzzFeed is down horrendous. They IPO'd last year, and they are down 89%. They're down 89% all time. So I think this may be the end for BuzzFeed overall. I mean, like, I don't know if they'll ever recover from a valuation standpoint. And we're going to talk further about overvalued companies probably never recovering and them probably going up in flames because of, a bunch of debt. I'm sure BuzzFeed at some point will file for Chapter 11 bankruptcy. I hope that they can restructure stuff and get it back on the path for profitability. But just with how they've been running the company and like the type of stances that they've been taking, and I would not buy BuzzFeed. I am not buying BuzzFeed right now, and I probably will not buy BuzzFeed until some seriously big changes happened from the company management level. I'm not touching BuzzFeed with a 10-foot pole. Speaking and then continuing on with layoffs, Plaid, basically the company, when you're trying to link your bank account to something else, they make it super easy. Plaid has laid off 20% of its staff today. CEO says Plaid's, quote, pace of cost growth outstripped our pace of revenue growth, and it is a familiar chorus in the industry these days. So they are spending more money than they have, and they hired too many people, and they were bloated, so they cut some of the fat off. Quote, macroeconomic conditions have changed substantially this year. Despite being well diversified across every category of financial services, we are seeing customers across the industry experiencing slower than expected growth. The simple reality is that due to these macroeconomic changes, our pace of cost growth outstripped our pace of revenue growth. The layoffs, quote, will allow us to continue to operate from a position of strength so we can best support our customers and the millions and millions of customers we jointly serve for the long term, the CEO said. The cuts represent about 20% of the company's count, roughly 1,250 employees. Same amount of employees as DoorDash that they laid off about, I think, last week. Again, to the people that were impacted by the BuzzFeed, Plaid, and DoorDash layoffs, best of luck to you. And of course, Morgan Stanley as well. All of those people impacted. Hopefully the severance packages were fat. Hopefully you get back on your feet and get employed. We at the Dylan Hoy Experience are rooting for you to go out there and be productive, money-making members of society, because y'all got it in the blood, baby. It's in your genes to be making that paper. Now, I spoke about BuzzFeed ad nauseum about them being overvalued and the stock going down significantly. Probably Chapter 11 bankruptcy on the horizon if they don't change their profitability structure, because I think BuzzFeed is hemorrhaging cash. There are a lot of major companies that IPO'd within the last 2 to 3 years that were basically the exact same business model. They are hemorrhaging money, and they IPO'd and they were overvalued, and then now they're all down 90% or more. One of those companies being Carvana. Carvana stock has collapsed amid bankruptcy fears after creditor pact and another $1 price target. Carvana shares spiraled Wednesday after the online car retailer's biggest creditors reportedly signed an agreement to cooperate in potential restructuring negotiations as the company faces growing bankruptcy risk. The company's stock plunged to nearly 43% on Wednesday. Now, if we take a little handy-dandy glance over at my Twitter, let's check this notification first. Oh my gosh, Gigameg liked it right off the bat, perfectly linking, bringing it all over. But if we look at the Carvana stock, it was actually at one point down over 46% in the trading session today. 46.27% exactly. It did rebound a bit. And then it came back down again to, I think, close like right about here. But I took this midday. But yeah, down 46% at its lowest point of intraday trading. Again, this is what happens. They not only were they an overvalued company that was hemorrhaging money, and then they IPO'd. I think overall we can just take a look at the. Oh, actually, I think Yahoo Finance already had a ticker. Boom, there we go, man. Shout out Yahoo Finance, always. But no, if we take a look at what basically has happened for basically the last year, it peaked at $349. It's at $3.83 today. It is down 99. It's down almost 99%. Since its IPO price, it's down almost 99%. The stock per share is $3.83. Its earnings per share trailing 12 months. So basically, the last 12 months of earnings per share was negative $4.18. This company is bleeding. Like it's like a fucking, we hit a main artery and they were bleeding out. That is how much money they are losing. I'm not surprised they're down 99%. And if you thought I wasn't touching BuzzFeed with a 10-foot pole, I'm not touching Carvana with a 20-foot pole. This is crazy, man. Like it's, yeah. So, and the bankruptcy stuff, the bankruptcy fears are not surprising. Let's take a look as to why. Bloomberg News, citing people familiar with the matter, reported on Tuesday a group of Carvana's 10 biggest lenders holding around $4 billion of the company's unsecured debt have made a 3-month pact to act together in the case of restructuring. Creditors' names in the report include Apollo Global Management and PIMCO. Full disclosure, Apollo Global Management owns Yahoo. PIMCO and Apollo declined to comment. Carvana did not immediately respond to Yahoo Finance's request for more information. Wednesday's collapse in Carvana's share price also comes as Wedbush analyst Seth Basham downgraded the stock to underperform and slashed its price target to $1 from $9 following news of the agreement, citing rising bankruptcy risk for the company. Now, if we actually take a look at Carvana stock, this guy, this stock downgrade, Carvana is going to collapse based off of what this dude is saying. Carvana is going to go down another like 65 to 70% from right here, and it's down 43% today. It's down 99% overall. Gnarly stuff, man. This move from creditors will help avoid the infighting among lenders that has occurred in other restructurings recently, Basham wrote in a note. We believe these developments indicate a higher likelihood of debt restructuring that could leave the equity worthless in a bankruptcy scenario. Basham also called Carvana's acquisition of ADESA's physical auction business back in May, quote, an ill-timed deal that, quote, has an albatross around its neck, not only adding $336 million of incremental annual interest expense due, but also saddling the company with additional reconditioning capacity that it does not need. So, what the hell is Cardano, hi, I want to offer promotion of your channel, viewers, followers, views, chatbots. The price is lower than any competitor. The quality is guaranteed to be the best. Auto on, incredibly flexible and convenient order of management panels. Everything is in your hands. Turn it on, off, /customize. Go to doghype.com. Fazalodi J. All right, he came in here offering view botting. Well, listen, ladies and gentlemen of the Dylan Holy Experience, members of the millions, I think now's I guess the perfect time. You will never ever see a fake eyeball watching the Dylan Holy Experience. At least to my knowledge. I will never view bot. I will never have fake followers. Everything that you see, everything that you get will always be genuine and transparent on the Dylan Holy Experience midweek market recap, end of the week market recap, and any special edition episodes that we do. We just want genuine eyeballs, man. We just want real people getting real info, real insight, and making real impactful decisions with the information that they get. And the best place to do that, I guess we can take a little spin here and do some shameless plugging, because you know that's what we got to be doing in this economy. If you follow me on Twitter, you know that's where I give my key takeaways. Basically any important news on the market is getting reported here. We also do some breaking news. We're going to be talking about one of the things that I put out, but Twitter is always the first place to get the first scoop of the market from @RealDylanHoly. That's my handle right there, @RealDylanHoly. And of course, you already know we're verified. Did I pay for it? Yes, I did. I full disclosure, I am paying for Twitter Blue, but hey baby. We got that beautiful blue little badge, of course, @RealDylanHoly for the first place to get news, key takeaways, and you are the first place to find out when I'm going live. They These people saw it out. Like anyone who follows me on Twitter, they saw like 6 hours ago that I'm going live. It's not a surprise, baby. And then of course an hour before as well, I also tweeted out that we're going live. So again, at Real Dylan Holy on Twitter, 54 followers right now, none of which were paid for. Thank you very much. We do not do that here. Twitch.tv/RealDMH. That's where we are live right now. I have the stream paused, but this is the best place to see me talk about news. And on top of that, there's another good place. Boom! YouTube.com/@DylanHoly right there. Look at that. Look at that. We have some videos up. We're going to be continuing to put some more videos up. But yeah, man, that's just the best place to see the Dylan Holy experience, man. Twitch and YouTube. And staying up to date at Real Dylan Holy on Twitter. Now let's continue on with some Carvana insight. So what the hell is Carvana's business model, man? Like they are in the auto industry, and it's basically like an online eBay for cars. But the issue is because Carvana acts as a middleman, they act as a way to get buyers to sellers and sellers to buyers. There's a certain degree of escrow and cars that they keep in escrow basically, and they have to finance debt to take out the cars, which works generally if you're going through a high amount of cars, because you can basically hold those cars at a super lower interest rate and then sell them off, and you don't have to pay very much in interest. You just jack up past the MSRP and the Kelley Blue Book value, and you make your money in basically those premiums there. The issue is that all of that hinges on an environment where interest rates are low and it's easy for people to get credit and capital to be able to buy those cars. And also there is demand to purchase cars. The thing is when you start bumping interest rates, locking up credit, draining savings from people, and you bet your sweet bucket, we're going to be addressing that right after we finish this point. Draining their savings, the demand goes down to be purchasing new cars. And now Carvana has financed all of these cars, and they're either not selling there, so they're just sitting liabilities, not making any return on investment, or people who do finance deals through Carvana, right now they're paying their loans and they're doing their monthly payments to all the creditors. That $4 billion is getting paid right now. But what happens when you start seeing an uptick in 90-day late payments, or payments that are 30 to 90 days late, which is what we are seeing. We are seeing an uptick in payment delinquencies across the board: credit cards, mortgages, cars, auto loans. So Carvana's entire business model hinges on a market where credit is easy to get and there's a lot of consumer demand. That is no longer that market. And if you start seeing further credit delinquencies, that's it. That's chapter 11 written right on over it. Now, Dylan, what were you talking about when you said draining people of savings? Well, if we run it back to @RealDylanHoly on Twitter, I was reading an article today and I found this very interesting graphic. Obviously, of course, source is JP Morgan Equity and Macro Research, but the draining people of savings, what JP Morgan Equity Macro Research is stating is household, quote, excess, unquote, savings will likely be gone by mid-2023. So personal savings in billions of dollars is this solid blue line. And what's happening is with COVID, so this blue line here, it was relatively steady. Then during COVID, they gave everyone that stimulus, everyone all that money, all those stock market gains, all of that plunge, PPP loans, SBA loans up the wazoo. Everyone got money. So everyone, their excess savings went through the roof. And then they dropped a little bit, and then they went back up. Joe Biden became president, and inflation started getting a little crazy, but the markets were still pumping out that cashola, so it didn't even really matter. But then the rubber hit the road in terms of the interest rates, and the physics caught up, and inflation caught up, and now we are seeing American savings rates be basically at their lowest at least from this chart, 6 years ever. This is the least amount of savings that Americans have had according to this chart. And by 2023, JP Morgan Equity Macro Research is saying that most Americans are going to be completely drained by mid 2023 because of how expensive stuff is, and how much they're paying out of pocket for stuff now. So a lot of these business models for companies that IPO or any debt-based company, everything hinges on the fact that people are constantly buying more stuff and the credit is available for them to be able to do so. And when you get rid of that, you're screwed. Your entire business model is meant for people to be constantly consuming, and when they don't have enough money to consume, then you're SOL. And then you match that, you pair that on top of market euphoria, where it doesn't even matter what the company technicals are, as long as they have a flashy name and it's a name that everyone that everyone knows, then they're just going to buy it. And when you're out of that market environment and the fundamentals of the business, they were already hemorrhaging money, but now they're hemorrhaging even more money. It's over. It's a wash. It's done. It's done. So yeah, Americans have less savings. This is the lowest amount of savings, at least according to this graph, that Americans have had in 6 years. And apparently it's likely, according to JP Morgan, to be gone by mid-2023. Now, speaking of savings, and actually speaking of companies that are grossly overvalued and were grossly overvalued and did correct, we have Robinhood. Now, here's the thing with Robinhood. Everyone hates Robinhood because they use payment for order flow, and they were an overvalued, and they're an overvalued company that doesn't pay a dividend, and they're still hemorrhaging money. And all of that is generally fair. But they did, guys, Robinhood did it good. And that is, Robinhood is going to pay a 1% match on all customer contributions to retail individual retirement accounts. Robinhood is bringing the concept of a 401k contribution match to its retail customers who may not have access to a retirement plan through the workplace. The retail brokerage will pay a 1% match on contributions its customers make to a Robinhood individual retirement account, the firm said Tuesday. Their firm is billing it as the first ever match paid to retail IRA customers, i.e. outside of a workplace retirement plan. Robinhood has more than 12 million active monthly users and 23 million funded accounts. It's rolling out its Robinhood retirement service broadly in January. Customers may also sign up for a waitlist starting Tuesday and get access on a rolling basis in coming weeks. Full disclosure, I have signed up for this, and I will at least roll over some retirement assets from another brokerage and financial institution just to test it out for science. But I really like this. I really like that they're doing this, and I think Robinhood moving into the retirement game was only a matter of time. And I think giving people more options is always going to be a plus. And if they can, if they have a Roth IRA, like if it's not just a traditional, I'm talking about Roth. If they have Roth, at the money, that's going to be beautiful, man. That's going to be fantastic. I'm extremely excited for this. I need to make that abundantly clear. Like, I think this is going to be a straight up game changer. Like the 1% match thing. Where the hell are they getting the money? But it is going to be SIPC insured, which basically means, we can actually pull this up here. SIPC Insurance is Securities Investor Protection Corporation. The Securities Investor Protection Corporation is a federally mandated, nonprofit, member-funded United States corporation created under the Securities Investor Protection Act, SIPA, of 1970 that mandates membership of most U.S. registered broker-dealers. Although created by federal legislation and overseen by the SEC, the SIPC is neither a government agency nor a regulator of broker deals. The purpose of the SIPC is to expedite the recovery and return of missing customer cash and assets during the liquidation of a failed investment firm. Basically meaning that the SIPC protection that Robinhood's going to have is $500,000. So what that means is, if you have $500,000, let's just say you what I'm going to be investing in, I'm going to have, I don't know if they're going to have mutual funds or anything, but the ETF I'm going to be looking, that I will personally be investing in, we can actually bring it up here. It is the Vanguard 500 Index ETF, VOO. That's everything in my 401k and my IRA, both Roths, so Roth 401k and Roth IRA. It's S&P 500 and then a small exposure to bonds. I'm still sitting 10% in bonds right now. Obviously not financial advice. Obviously me not telling you what to invest into. I'm just giving you transparency into what I invest into my retirement accounts. And if they don't have any mutual funds, I will just be buying VOO, dollar cost averaging into that. Call it a day. And let's say I end up, getting a decent stack. So I have $250,000 of VOO in my IRA account from Robinhood, my Roth IRA account from Robinhood. Let's say Robinhood goes under. Let's say it pulls an FTX. Regardless of if the company goes under or not, or the financial institution goes under or not, I will still be entitled to be able to get those assets and move them to another financial institution. It's basically like FDIC insurance, but instead of the value of the you'll still be able to lose money on the investment. But if the financial institution were to go under, then you're protected for, you can still get all of the assets that you had and be able to transfer them over. So I'm very excited for the Robinhood 1% match. I think this is going to be a net good for investors and retail investors as a whole. I mean, they just opened easy retirement investing to 12 million monthly active users and 23 million actively funded accounts. Anyone who uses 23 million people who use Robinhood are going to have the ability to invest into an IRA account with like an industry leading match, an unprecedented IRA match on their investments right at their fingertips. I'm sure it'll be a much better investing experience than Fidelity and Vanguard. Full disclosure, I use both of those right now for my retirement apps. I have split 401ks in between both of them, and I'm excited to move some stuff over into Robinhood, see how that experience is. I will keep you guys filled in on how the rollovers and everything go. But yeah, man, just fantastic stuff. I'm very excited for this. Now, speaking of companies that like Robinhood's definitely meme stock status, and I think a big thing that brings apprehension toward Robinhood is that it shut down the meme stock stuff. You know, they basically locked the ability to sell GameStop and buy GameStop at different points. So there was a certain degree of anti-consumers. Also, their payment for order flow stuff. Basically, how Robinhood makes money, because it's a zero fee brokerage. Anytime there's a buy order, we can actually pull up a graph too in a chart, so we can do that. But every time Robinhood, someone buys a stock on there, how they make money is they basically route the transaction to a market maker or basically a financial institution that has that, and they sell it at a certain margin. So Robinhood makes money on the actual margin. So let's say, someone buys a stock for $99.75, but then the market maker sells it for $99.25, because Robinhood is marking or is sending all of that traffic to that market maker, then they're making about 50 cents per transaction. And like the margins that they're operating at are like fractions of pennies most of the time, but generally that's how Robinhood is making money. They're sending customer volume and stock volume to certain market makers to make the most amount of money possible. Now, for trading and like margin trading and options trading and stuff like that, going down to the pennies it makes a big difference, because if there's any price disparities, then that's an arbitrage opportunity and people can end up getting screwed there. But for retirement investing, I don't. It's a non-issue. Like, it's something that's there, but like, of course, the company's going to be selling, or it is going to be basically selling user volume for the highest possible margin. And with the amount of compounding, like, you're going to be holding these assets in your retirement shelters For 4 decades, for 40 years, you're going to be holding it. So who cares if you're paying like a little more for a stock then? It's literally going to be a non-issue. It is a non-issue. It's a non-issue for me. I don't think like payment for order flow is generally fine. Like obviously there could be some anti-competition stuff. And again, if you're trading, then it can make a difference. If you're like if you're investing, if you are investing, payment for order flow is a non-issue. It's truly a non-issue. But again, it is one of those controversial things that Robinhood does, and the company itself is grossly overvalued. But it's down 73%, and I think generally Robinhood is considered a meme stock by most people. I mean, it was the brokerage and institution that everyone used to invest into meme stocks. And speaking of meme stocks, GameStop, they announced their quarterly reports today. GameStop has reported worse than expected quarterly loss and revenue decline. Who would have thought? It's like a dying business model. And the only reason GameStop is still relevant was because there was that short squeeze, and there's still people holding it. Like they like hodling, like it's just hodling with diamond hands. That's it. GameStop said it lost $94.7 million or 31 cents a share in the third quarter, compared with a loss of $105.4 million or $1.39 a share in the prior year's quarter. Not surprising. I think GameStop's going to keep losing money. It's not a blue chip. It's crazy to me that a lot of people's first experience with investing was through like GameStop and AMC, and now they got burned, and now they're gonna have apprehension towards investing in basically anything. I mean, like it was like GameStop and Dogecoin were like most people's first foray into investing. That's ridiculous to me. Not blue chips, dude. Not blue chips, but like just shitty marketed like get rich quick schemes and pump and dump schemes. I guess this dude, Dogehype.com. I mean, they're still banking on the brand equity of Doge. Speaking of blue stocks or blue chip stocks and blue chip assets, this one went under the radar today. It's nothing surprising. It's just, it's good to have transparency and a spotlight placed on this. There was a defense contract called Return of Jedi. That was the actual. It's not Return of the Jedi, just Return of Jedi. And there were some major corporations that were basically given $9 billion worth of capital by the U.S. or by the Pentagon, that being Google, Oracle, Amazon through Amazon Web Services, and the Microsoft Corporation. It's basically just gonna be cloud capability. It's all cloud stuff, and they're just giving them $9 billion. Not surprising, but yeah, they're getting some money from the government. And I'm sure they will act in the best interest of shareholders and Americans as a whole with this money. I have absolutely complete faith that they will act in our own self-interest. Now, speaking of the government acting in their own self-interest, or the government acting in the self-interest of Americans, we're going to have some accountability possibly placed onto Alexandria Ocasio-Cortez, and she is currently under investigation by the House Ethics Committee. The House Committee on Ethics, which I think it's hilarious that the House and the Senate has a committee on ethics. They should just be investigating everyone. Everyone should be guilty. Anyway. The House Committee on Ethics is investigating Representative Alexandria Ocasio-Cortez, according to a statement the panel issued on Wednesday. The statement, which did not provide many details about the inquiry, said that the panel will announce its course of action after its organizational meeting in the next Congress sometime in 2023. A spokesperson for AOC said that she was confident that the case would be dismissed. Quote, "The Congresswoman has always taken ethics incredibly seriously, refusing any donations from lobbyists, corporations, or other special interests," spokesperson Lauren Hitt said in a statement. The nonpartisan Office of Congressional Ethics forwarded its inquiry into Ocasio-Cortez to the House Ethics Panel in June, according to the statement. Typically, when that office refers an investigation, it is because the office has reason to believe an ethics law was broken. Wednesday's statement attributed To acting chair Susan Wild and ranking member Michael Guest notes the disclosure of the investigation, quote, does not itself indicate that any violation has occurred or reflect any judgment on behalf of the committee. Good. There should always be scrutiny placed on politicians and public officials. And listen, everyone is heralding AOC as this freedom fighter. She has a grassroots movement. I think there is money being given to her by a special interest somewhere, frankly. And obviously this is not like an indictment, and this is not be saying like she's guilty, she's guilty, she's guilty. Again, innocent until proven guilty in America. So right now she's still innocent, but I wouldn't be surprised. I mean, she's a politician. Like she's one of them. And people can say like, oh, she's a freedom fighter. She fights for us. She's for the people. They're never for the people. They are never for the people. So it's good that there's going to be scrutiny placed on it. Again, I don't know what's going to come of it, if anything at all. Could all just be fun. Could just be some fun little some fun little charades, offset. Have some a total diversion from something else. But yeah, there's scrutiny placed on her. There we go. I think that's everything, man. I think we got everything that we need to get out. Thank you very much for watching. Midweek market recap as always on the Dylan Holy Experience. It's much appreciated having you all come by, having a little discussion. Now again, we're going to do some shameless plug-in right at the end of things. So if you liked what you saw, be sure to give us a follow on twitch.tv/realdmh. Always live over there, as well as youtube.com/@DylanHoly, giving you your midweek market recap, end of the week market recap, and of course, special editions of the Dylan Holy Experience, like the 2022 midterm election extravaganza that happened a few weeks ago. There was also a Labor Day special as well, talking about labor rights with myself and my very labor union focused friend Adrian. It's always a pleasure having him on. And of course, if you want to see where the sausage is made, we always have breaking news going up on Twitter, and of course key takeaways on the market. And you are the first to know whenever the Dylan Holy Experience goes live. It's going to be @RealDylanHoly, so twitter.com/RealDylanHoly. Be sure to give that a follow, and I thank you humbly always for watching. It's always a pleasure, and you all have a great rest of your night. I'll see you soon.